Hello everyone, welcome to our case evaluation of the Ferrari IPO. As you can see here, we have a pretty packed agenda, so without wasting any more time, let's meet the team. First off, my name is Tyler Toden. I will be opening and closing our presentation today. John Michael Dancy will be talking about Ferrari's positioning within the industry. Roy will then talk about the IPO structure, along with some analysis into the discounted cash flow, and Max Hale will talk about the comparable company analysis. Ferrari was founded in 1947. It's important to point out here that they're not just in the automobile industry like a lot of people think, but they have other revenue streams. That's where they get put into that luxury good. They have their own clothing line, along with their developing theme parks, and they have an F1 team and all the sponsorships that go along with that. Another thing that I think is very important to point out is that they're an industry leader within their profit margin, which definitely helps in bringing in more revenue and keeping the bottom line looking a little bit better on their balance sheets, income statements, cash flows. One thing here that I would like to point out too is the IPO structure. Obviously, this is an equity carve-out, so it's going to raise a lot of capital for FCA, also while letting Ferrari spin off into its own company. For our summary statistics, it's important to point out that we did get a lot of different implied share prices, but in the end, because Ferrari is in both of those markets, we decided to mainly look at our discounted cash flows to bring together all the analysis to get an implied share price of $52.37 to $57.51. I'll now pass it to John Michael Dancy to talk more about Ferrari's industry positioning.
Thank you, Tyler. And just to touch a little more on what he was speaking on, I'll be going into the market and industry for automobiles. So the industry as a whole grew 11.05% over the past year, with the luxury car market having the highest sales in the Americas, Germany, China, and Eastern Europe as a whole. Focusing on China, they were by far the largest market for automotive sales, growing 20% from 2010 to 2015. China also bought roughly 1.5 million units in automobiles. The industry has been divided into two subsectors, both can be seen to the right: normal premium and super luxury. Normal premium are those typical everyday consumer cars, while super luxury is falling more and more into sports cars. Luxury cars have been debated to be considered luxury good due to the level of customization and time of production needed to produce. The luxury goods industry has seen roughly $257 trillion in revenue in 2015 alone, and it opens a lot of stuff up for debate, such as, are consumers shifting more towards it's a one or the other choice, where it's either a sports car or a luxury good from a designer brand. Historically, the premium car industry has had a large range of entry points, and this is mainly due to globalization and the large spread of countries that are getting involved in making these luxury cars. The debate of luxury cars being considered luxury goods opens the industry to more competition from designer brands. Like I said, it's becoming more of a trade-off between these designer brands and buying a luxury car. Boutique brands that offer premium customizations are taking hold in the industry because they're providing producers with large profit margins and are offering consumers customization of their automobile from start to finish. So this really is opening the industry up to more competition in the coming years. Speaking more on Ferrari and what they've been doing, and founded in 1947, Ferrari is among the world's leading luxury brand and one of the most recognizable brands when it comes to all forms of automobiles. They have a very large global access, with the top revenue driving countries being the Americas, China, and Germany. Ferrari has developed a model throughout their years, allowing them to bring new automobiles to market in under 4 years. And this is known as the racing heritage model. It really allows for Ferrari to produce these cars in very efficient ways. And this is due to the fact that they were a racing brand trying to compete, being the best and the fastest, and they adopted this mentality to everything that they do. And it shows. As of 2015, Ferrari had one of the largest revenues driven from their product alone at roughly $3.986 billion. Ferrari has taken a unique marketing strategy within the luxury car market that not a lot of other companies have been doing. They're keeping their traditional marketing costs low and using the success of their Formula One team to market their product and show that a Ferrari really is the best car on the market. And to touch a little more on Ferrari with FCA, Ferrari was a large revenue driver for them in the luxury car space. They brought in $3.141 billion for FCA in 2014 alone. Ferrari was also 10 times oversubscribed upon the announcement of this IPO, and it's due to several different factors. They had the largest return out of any luxury car maker on the market at roughly $80,000 per car. Their global exposure also allowed for a lot of room for growth within the entire world. And in these markets where new companies are popping up, Ferrari still holds true that they are the best car there. Since its founding, Ferrari has continued establish consistent selling patterns. Like it was said earlier, every 4 years they might be able to produce a car, but they can wait to increase their own demand and hold their future in their hands. While with FCA, Ferrari also found steady revenue streams from non-car related operations, consisting of theme parks, sponsorships, licensing agreements, and the Formula One team. Above all else, Ferrari's commitment to engineering excellence can be seen in the high-quality products they continue to offer the public. And once again, it shows. Ferrari has grown their EBITDA 5.8% compounded annually over the past 3 years and recorded an EBITDA of $722 million in 2015. And now Rahul is going to speak a little more on the IPO structure itself and the aspects of that.
Awesome. Next, I want to talk to you guys a little bit more about the deal structure. So FCA is looking to do an equity carve out of 10% and sell that to the public markets. Next, FCA is looking to do a stock spinoff of 80% of Ferrari to their existing shareholders through a stock dividend, and the remaining 10% will be retained by the Ferrari family. Next, I want to talk to you about a little bit more about the reasoning behind this. So FCA is looking to give Ferrari direct ownership to the management team. Secondly, they're able to raise a good amount of capital. Thirdly, they're able to transfer some of their debt to Ferrari's books. And fourthly, they're able to market Ferrari in a more effective way to the U.S. markets by having a stock on the New York Stock Exchange. And lastly, this definitely unlocks some hidden value for both FCA shareholders as well as Ferrari shareholders.
Thank you, Rahul. Now we'll continue with some analysis that we conducted for this IPO and for Ferrari, including comparable companies analysis as well as discounted cash flow analysis. Here on the next few slides, I'll focus in on comparable companies. If you move to slide 9 with me, you'll see that we separated it into 2 peer groups, automobile peer groups, and on the next slide, we'll go over the luxury goods peer groups. But here you can see that we've broken it down into revenue growth, gross margin, and EBITDA margin, benchmarking Ferrari against its peers in this space. As you can see, Ferrari pretty much outperforms each of its comparable peers in each of these separate 3 categories based upon its revenue growth, gross margin, and EBITDA margin. And you can see on the right side, we've also provided a peer median so that you have a reference to compare the average or median of the peers in each of these 3 categories compared to Ferrari. Now, reference this as you will. We'll move on to slide 10, where we'll look at the luxury goods peer groups separated into the same 3 categories. Here you can see that Ferrari matches up a little bit, doesn't outperform these peers, these luxury goods peers, based upon the fact that luxury goods brands, retail brands specifically, tend to have a higher gross margin and EBITDA margin based upon upmarketing their products. As you can see, Ferrari also competes in the automobile space, so it outperforms the automobile peers, but tends to come in the middle of the pack based upon these 3 categories within the pure luxury goods peer groups, keeping in mind that these companies do not compete in the automobile space. We've also provided peer medians on the right side for each of these 3 categories: revenue growth, gross margin, EBITDA margin. And if you'll follow me to slide 11, we've also conducted some valuation benchmarking based upon enterprise value to EBITDA multiples. Here, we've broken it into the same 2 groups, automobiles and luxury goods. You can see that for the automobiles, they range with their EV to EBITDA multiple of typically between 11.4 to 3.5x EBITDA. We found an implied share price of $12.62 to $28.95, providing a plus 2x and minus 2x range for the median 7.7x multiple for this group. Done the same thing for the luxury goods peer group, which ranges from 22.9 times EBITDA to 9 times EBITDA, Hermes to Prada, and found an implied share price using a median of 11.6x with +2 and -2x as our range for this multiple, and finding an implied share price of $28.40 to $44.73. Now I'll throw it back to Rahul, who will go over the DCF analysis that we have conducted. Thank you.
Perfect. And now moving along from the comparable companies analysis to the discounted cash flow analysis, as you can see, we came up with an implied share price of $52.37 to $57.51. There were a few key assumptions that came to this valuation. Firstly, the implied share value range was based on a terminal value EBITDA exit multiple. And the range that we used for this implied share price was 11.56x to 12.56x. The 11.56x EV to EBITDA multiple came from the luxury peer group median. And we believe that Ferrari's position in the market better than both its luxury brand competitors as well as the car competitors. And that's why we use the upper bound up to 12.56x, which resulted in an implied share price of $57.51. The cost of capital was estimated at 5% based on comparable companies as well as European market data, and taxes were set at 38% to represent the Italian tax rate in which Ferrari would operate under for their profits.
Thank you, Raul. As you can see, we believe that Ferrari is successfully placed within the industries that it is involved in, being that you get the extra value of the F1 team, all the sponsorships that come with that, development of theme parks, and obviously the clothing lines, luxury goods, and the automobiles in general. We believe also that the IPO is successfully placed at $52, and being that we got an implied share price from our discounted cash flows slightly above this, we do encourage people to invest in the IPO of Ferrari, being that you can get the extra added value after trading begins. Thank you for your time today, and we hope you enjoyed the presentation.